Hi, I'm Russ Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, we're thrilled to be joined by Managing Director and Head of Fixed Income Research, Tom Tzitzouris. Tom, how are you doing this morning?
Hey, good morning, Ross. Thank you for having me.
Yeah, good to talk to you. I want to talk everything inflation, job market, how it interplays with rates. But, one question that I think is looming pretty large over the market as the 10-year Treasury yield has declined a bit in recent weeks is the question of when it stops being a good thing and when it starts being a concerning thing, right? So the idea that it could be coming down, good for risk assets, inflation coming in lower, but at a certain point, it becomes a message about growth. Is there a trick or a tool that you use to kind of differentiate between those two things?
Well, there's no real rule of thumb, but what I would say is we can intuitively think about this from the perspective of where is the Fed funds rate going to be under those different economic scenarios. And what I mean by that is right now, as long as the market thinks that the Fed funds rate is going to be tweaked lower just to kind of adjust it into a soft landing because the market thinks the Fed funds rate's a little too high, then that means that the Fed funds rate's probably not going to drop more than 75 to 100 basis points or down to about 4.5%. Once the market starts to think that the Fed funds rate is going to have to drop by a substantial amount more, let's say down to 3% or 250, because there's an economic panic that's building or a financial market crisis, then it becomes a bad thing. So as long as the market thinks that the Fed is just adjusting short-term interest rates to just kind of tweak it for a slightly slower economy, then any movement in the 10-year yield that coincides with the Fed funds rate going lower is viewed as a good thing. So then just straight numbers, that would suggest to us, well, if the Fed funds rate's coming down to 4.5%, then 10-year Treasury yields, they can actually come down to 4%, be a little lower than 4.5%, and it's still kind of a good thing. Once they all start moving below 4%, 10's moving below 4%, future Fed funds rate expectations moving below 4%, now you're not just talking about a mid-cycle adjustment. Now you're talking about something that looks like and is beginning to feel like an economic anxiety attack.
And it's a narrow path, obviously, because anything pushing towards 5% on the high end has proven problematic for equities. So it really is this kind of narrow strip for a soft landing. You mentioned if it goes any lower than 4%, it might reflect more economic anxiety. The last two kind of major crises and Fed cutting events have basically been to zero. Is the floor of the Fed funds rate higher this cycle because of inflation? So all to say, if there is, a crisis or a recession, can the Fed not cut as much as they may have in previous cycles because of the inflationary impulse?
Oh, absolutely. I think the floor is higher. Now, I want to differentiate between a higher floor in an economic downturn and a floor in a crisis. If there's a crisis, the floor is still zero. By crisis, I mean if you have a financial system crisis, if you have a geopolitical crisis, the floor is still zero. But absent that, even in a deep recession where the financial system remains unscathed, I'd say the floor is probably down to about 3%. Which is notably higher than the last three economic contractions where we went progressively lower. So 3% is probably the floor, and that would be consistent with inflation getting stuck somewhere between 2 to 3%. So I don't want to say 3% exactly. Somewhere around 3% is probably the floor, and what we would see is a reasonably weak economy that where there's no financial system crisis. Now, again, that depends on inflation, and to your point, is inflation going to be higher this cycle than we've seen in last cycles? And I think the answer to that is absolutely yes. Even if inflation comes down to the Fed's target of 2%, the odds of it going below 2% and staying below 2% are very slim at this point in time, outside of a financial crisis that really destroys aggregate demand. So I think that floor on the Fed funds rate is probably going to be somewhere around 3%. In an economic soft patch where we do actually go into contraction.
So with all of that kind of economic backdrop commentary, how are you positioning? What's the highest conviction kind of area of the fixed income world that you see value in or you see value in adding to right now?
Yeah, and I'll be honest, we're quite boring investors at this point in time in the bond market. We've been overweight, structurally overweight investment grade corporate credit for 6 years, and we see no reason to change that right now. And so that is our highest conviction trade, a modest overweight to investment grade corporates. That also leads to a slight overweight to duration. So we have a slightly higher than benchmark exposure in duration to investment grade corporates as well. So with that market value overweight and with that duration overweight, we do have some higher interest rate exposure in IG corporates. And we're very comfortable with that right now because we do not see anything weaker than a soft landing in the US for 2024. But with that said, we really do not see much value in the high yield space or the bank loan space, or even in the commercial mortgage-backed security space, where we see there's much greater tail risk in terms of, even in a soft patch, valuations look too rich to us in those sectors. So we're sticking with that investment grade corporate overweight. It's very comfortable. It's something that we have a high conviction on. And we also, for now, do expect that the Fed is going to tweak that Fed funds rate lower into what is still a growing economy, which should continue to support credit, particularly investment grade credit in that cycle, in that portion of the cycle.
Tom, thank you so much for the time today. I appreciate the insight as always, and hope to talk to you again soon.
Thanks.